Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. I am Kishore Muktinutalapati, equity strategist for ADCB. On this show, with an objective to empower you with investment insights, my colleagues and I will be discussing various perspectives shaping the global investment landscape. This week, we start by discussing the bigger picture perspective, or the so-called 30,000-foot view of the global economy and what that means for global investors. Market participants who believed that most major global economies would rebound from last year's slump in a lockstep have been disappointed this year. The rebound in manufacturing and services sectors in various economies was influenced by a range of factors and remained diverse across major global economies. These factors or influences included the spread of the new variants of COVID-19 virus, reaction function of the governments to rising infections, rate of vaccinations, conduct of monetary and fiscal policies, and of course, some idiosyncrasies. On the situation with COVID-19 this year, it looked like the East decoupled from the West. Whilst Asian economies struggled to contain the spread of the Delta variant, with increased number of cases and hospitalizations, Western economies handled it reasonably well. Thanks to higher vaccination rates, the US, the UK, and to some extent Eurozone managed to decouple hospitalizations from increasing case counts. This meant that government's response to increasing COVID-19 cases was different between the East and the West, with the East being more restrictive and West less so. On the policy support, it is fair to say that emerging markets remained on a slower lane. Emerging markets have not only significantly lagged their developed market counterparts in the fiscal easing, but also moved rather quickly to normalize their monetary policy from ultra-easy levels to counter rising inflation. Staying with emerging markets and speaking of idiosyncrasies, it is worth noting that China's economic position has been markedly different from the rest of the world. China's response has been more hawkish, not only in terms of central bank and fiscal policies, but also in terms of its zero-tolerance approach to the spread of COVID-19 variants. This, in our view, has pushed Chinese economy further ahead into the mid-cycle setting, while most other economies around the world remained in an early cycle phase. All these speak to the asynchronous journey that lies ahead as economies move past the early cycle phase into a mid-cycle environment. Such transitions in a cycle that is moving rather faster than normal are usually associated with higher uncertainty and financial market volatility. However, as the cycle matures into a new normal, uncertainty should start to diminish and provide a reasonably clear path for financial markets. Moreover, this transition, which we think is sequenced and not synchronized, creates opportunities for investors. Over the next 12 to 15 months, as China slowly gets out of its mid-cycle downswing, we think Asian economies are likely to fare better compared to the Western world. From a cross-asset perspective, we are now more constructive on Asia than we were a few months ago. For instance, we've recently upgraded Asia Pacific equities to an overweight and remain overweight emerging market Asia investment grade corporate credit. The risks to our constructive Asian investment thesis, however, include weaker exports due to persistent supply side bottlenecks or weaker than expected demand for technology hardware, or a sharp rise in long-term US Treasury yields causing taper tantrum and excessive US dollar strength, geopolitical risk-off event in the region and emergence of new virus variants alongside slower vaccinations hindering the lifting of restrictions are all additional risks. But overall, we have a constructive outlook for Asian assets over the next 12 to 15 months, and that is reflected in our portfolio positioning. Thank you for listening. For more on the outlook for major economies, asset classes including equities, fixed income, alternatives, and currencies, please look at our hot off the press quarterly investment view report, which can be got either from our website at www.adcbam.com or by simply asking your contact at ADCB. Also, subscribe to this podcast on the ADCB YouTube channel or wherever you listen. If you liked what you have listened, we would appreciate it if you could share this podcast with a friend or a colleague. This is Kishore Muktinutalapati. Talk to you next week.